Hello, everybody, and welcome to Fuqua LinkedIn Live. This is Elia Ferracuti. I am an assistant professor in accounting, and I will have the honor and privilege to share my work with you today. Now, before getting started, a little bit about the rules of engagement. I'm going to talk uninterruptedly about my work for about 20 minutes, and then we will open the room to Q&A for the remaining 10. Now, this structure, nonetheless, I encourage you to post your questions in the chat at any point during the presentation, such that we can build a pipeline of questions that I can attack as soon as I'm done with my mumbling. So let's get started, and let me share my slides with you to see what I'm talking about today. We're going to talk about topics that have to do with corporate investment, inflation, and internal information systems. And the work I'm going to share is co-authored with two colleagues and friends of mine, Oliver Beans and Peter Juice, both of whom are at INSEAD. Now, before delving into this specific piece of research, I want to tell you a little bit about what I do more broadly and how this work belongs to my broader research agenda. So the type of work I do always has something to do with information choice models. And those are models that attempt to explain what economic agents choose to do, namely what kind of information they acquire and what kind of issues they pay attention to, and conditional on what economic agents choose to know, what economic actions they decide to take and the consequences of those actions. The work I'll share with you today belongs very much in the second word. So conditional on what managers choose to know, what kind of actions do they take? Now, I decided to present a paper on inflation, and I think the reason is quite obvious. If you follow the news or if you simply buy groceries, you will have noticed that inflation has reached levels that we haven't seen in the past 30 or 40 years. As you can see in the graph in the slide, which I borrowed from the US Bureau of Labor Statistics, the levels we have today, even after a few months of declines, are unprecedented over the past few decades. Now, as a consequence, inflation has been at the center of our attention. And as you can see in the slides, the results from a Gallup survey confirm this intuition. In particular, what you see is the answers to the question, what do you think is the most important problem facing the country today? And respondents consistently put high cost of living and inflation at the top of their consideration. Now, this picture extends not only to the general population, but also to executives. And what we have in the slide is the answer from CFOs to the question, what is your firm's most pressing concern, asked as part of the CFO survey, which Duke co-sponsors. And as you can see, once again, the top of the concerns for CFOs is represented by cost pressure and inflation. Now, given the center stage that inflation has taken during the past couple of years, my co-authors and I were curious to better understand how inflation and firms' corporate investment relate to each other and whether there is an interplay between the two, which broadly speaking is the goal we pursue with our research. And to give you a little bit of a broad overview of what we do and what we find, in the paper we ask two main questions. The first question is, how does inflation influence corporate investment? And what we find is that there appears to exist a positive association between the two, meaning that when firms face a positive or larger inflationary shock, they also seem to respond by investing more. Now, given this baseline result, we try to go a little bit deeper and try to understand heterogeneity in that effect. And in particular, what we study is whether there is a role to be played in mediating this relation for firms' internal information systems. And what we find is consistent with this notion. And in particular, it appears that this positive association between inflation and investment is muted for firms that have superior internal information systems. Now, keeping those results in mind, why would we even expect any association between corporate investment and inflation? So let's try to understand why that's the case using a quite simple framework. So let's imagine the following scenario. We have a managerial team which receives financial information and uses that information to make investment decisions. For example, if the signal the managerial team receives is positive, they're likely to increase their investment, whereby when the signal is negative, they're likely to reduce their investment compared to their budgeted amounts. Now, let's add one layer of complexity to this simple framework by recognizing the notion that firms' financial performance is driven at least by two different types of shocks. Let's imagine the situation in which changes in financial performance can reflect, on one end, what I'm going to call idiosyncratic shocks, such as changes in consumer taste. Those are shocks where consumers change their preference for products, either in favor or at the detriment of the firm's product relative to their competitors. So those are shocks that apply exclusively to the focal firm. Now, at the same time, changes in firms' financials can occur also as a reflection of aggregate or nominal shocks, where those are shocks that apply across the economy, and therefore they do not change the relative position of the firm compared to their competitors or their peers. Now, from a conceptual standpoint, ideally, managers' investment decisions are affected exclusively by idiosyncratic shocks and not by nominal shocks such as inflation. The reason being that those nominal shocks do not cause a shift in the relative position relative to competitors, and therefore they only cause a short-term change in product demand that will then revert to the prior level once prices have reached a new equilibrium. So again, ideally, managers would like to respond in terms of investments exclusively to idiosyncratic shocks. However, when we go outside of this experiment and we move toward the real world, the situation is a little bit more complex. And the complexity stems from the fact that what managers see is a signal about their financial performance that commingles different shocks. What they see is a number that reflects a combination of idiosyncratic and nominal shocks that they are unable to perfectly separate from each other. And as an example of this difficulty, we can take a look at a Wall Street Journal article that describes expectations about US retail sales. As you can read from the article, US retail sales are expected to increase in October, pushed higher by strong household demand, which reflects an idiosyncratic shock, but also accelerating inflation, which would be a nominal shock. So this is an illustration of the difficulty that we face in separating those two concepts. Now, this situation and the impossibility to know perfectly the drivers of firms' financials puts the managers in a little bit of a difficult position. They would like to adjust investment only in response to consumer taste, for example, but they don't know whether their financials are driven exclusively by consumer taste, exclusively by inflation, or a combination of the two. Which means that they face a difficult position. So put yourself in the shoes of those executives and think about your investment options. Let's assume you receive a positive signal and you decide to invest. In that case, with some positive probability, you will have responded to a signal that reflects nominal shocks. And as such, future demand will go back to the original level and your investment will represent capital misallocation and an inefficiency. Now, on the other hand, let's assume that you receive the same positive signal and you decide not to invest. On that occasion, it is possible with positive probability that the positive signal represented an idiosyncratic shock. And as such, by not investing, you are giving up on a positive NPV investment opportunity that may put you at a disadvantage relative to your competitors. So in this scenario, it turns out that the optimal course of action for the manager is to be a little bit cautious, which means invest less than they would in case of perfect information, but at the same time, continue to invest more in response to positive signals. Now, as a consequence of this optimal behavior, we will end up in a world where there should be exposed a positive association between managers' investment decisions and nominal shocks such as inflation. Now, I want to clarify something important here. Managers are not being stupid. They're not making bad decisions by investing in response to nominal shocks. What they're doing is making the optimal course of action, the optimal decision, given the information available to them at the time. So given that that information is imperfect, on some occasions they will be wrong ex post, but that doesn't mean it was the wrong decision to start with. Now, in my research, I rely often on theoretical models, but I also like to get comfort from observing similar dynamics to the one I described from the news. And in this project specifically, we were lucky enough to find some of those dynamics in the news. So let's go through three examples that exemplify our logic here. Let's start from an article from October 24, 2021 in the Wall Street Journal titled, "US Companies Bet Shoppers Will Keep Paying Higher Prices." And I want to point your attention toward the last paragraph. So let's read it together. "We have not seen any material reaction from consumers," P&G Finance Chief Andre Schulten said last week, referring to a string of price increases that went into effect in September. So that makes us feel good about our relative position. What I interpret from this sentence is the notion that P&G's managerial team received a positive signal and they attached a positive probability to that signal that it reflected idiosyncratic shocks that put P&G in a stronger relative position compared to their competitors and therefore will be sustained over time through higher demand. Now let's shift a few months forward to April 20th, 2022, when it became kind of obvious to everybody that the US economy just went through a significant inflationary shocks. And let's see how the language changes. Again, let's read together the last paragraph in the slide. "We don't assume that what we are seeing to date is necessarily an indication of what will happen in the future," Mr. Schulten said, the same executive mentioned before. "We are very well aware that consumers may end up looking at budget constraints," which the way I read this sentence is that now that it's obvious to everybody that inflation was a major driver behind financial performance, we are aware that demand for our products may revert back to its original level. And lo and behold, we can shift forward by another few months to January 19, 2023, and we see that P&G's earnings slip as those higher prices that were accumulating because of inflation led to lower demand, resorting the demand level to the pre-inflationary shock level. So this is just an illustration of the logic that we have in mind, but it gives us some comfort that our story is not far-fetched in reality. Now, so far, we predict a positive association between inflationary shocks and firms' investment. So what we asked next was, what could explain variation in that relation among firms? What could be possible drivers behind that relation? And as accountants, immediately our attention went to the quality of information available to managers when making those investment decisions. And again, as accountants, we know that one of the main drivers of that information is represented by the firm's internal information system, which is basically the set of individuals, technologies, and procedures that gather data on economic transactions and try to convert that data into a useful signal for managerial decision-making. So one good way to think about internal information systems is as if they represent a filter that receives a bunch of data and attempts to filter the noise from the signal to support managers' decision-making. Now, in the accounting research and in practice too, what we know is that when firms invest more in their internal information systems, for example, by adopting technologies such as ERP, customer relationship management, the information that the system supplies to managers is of higher quality. And again, we have lots of examples in practice too. This is simply an article from the CFO magazine that lays out all the benefits in terms of forecasting ability that comes with adopting superior technologies. Now, to the extent that better internal information systems provide managers with better information, what we should observe is that this positive relation between inflation and investment, which again represent an economic inefficiency, should be muted for firms with better internal information system, because their filtering mechanism should be better able to tell the managers whether the drivers behind their performance is a nominal shock, such as inflation, or an idiosyncratic shock, such as changes in consumer taste. So broadly speaking, so far, what we're expecting is a positive relation between inflation and investment that gets smaller as firms invest in their internal information systems. Now, clearly, this is not easy to test in the data. So what we tried to do was to come up with a sample that encompasses approximately 5,000 firm-year observations that are distributed over a 10-year period for approximately 20 countries. And what we're going to do is to study how investment, which represents the variable of interest for us, is going to change as a function of inflationary shocks and, at the same time, the quality of firms' internal information systems. And to make your life a little bit easier here, what we would expect is to observe a positive beta 1 coefficient that you see in the equation in the slide, which signals a positive association between inflation and investment, and a negative beta 3 coefficient, which signals that this effect is muted when firms' quality of internal information systems increases. So when we take this equation to the data, that's exactly what we find. As you can see from the first row in the slide, the estimated beta 1 coefficient is positive, as expected, statistically significant, but also economically meaningful, as it indicates that for each extra percentage point of inflationary shocks, firms are going to increase their investment by 1% relative to their total assets. So for each 1 percentage point increase in inflationary shocks, a firm with an asset base of 100 million will increase their investment by 1 million. Now, furthermore, if you go down the table to the third row, what you can see is that beta 3 is negative as expected, again, statistically meaningful, but also economically meaningful as well, as it indicates that a 1 unit increase in the quality of firms' internal information systems mitigates that relation between investment and inflation by approximately 30%. Now, at this point, you may ask to yourself, well, why do we care about this? What are the real implications? And the real implications come in terms of economic efficiency. In particular, if our story is correct, we should see that firms experience on average lower profitability following inflationary periods, and that lower profitability is mitigated for firms with better internal information systems. So what we do is replicate this analysis, but this time replace investment on the left-hand side with investment efficiency or firm profitability. And what we find is once again consistent with our expectation, which gives us some comfort about our story. We see that inflationary shocks lead on average to lower future performance, as you can see from the estimated coefficient in the first row. And on average, we observe that that effect is smaller for firms with better internal information systems, which is what you can see in the third row of the table. Now, to recap what we've seen so far, we studied how a macro shock, such as inflation or any nominal shock, influences the microeconomy by affecting firms' investment decisions. However, it is possible that those dynamics change a lot at the aggregate country level as well. And that's possible because firms, on average, are firms with very different levels of internal information system quality. As you can see from this graph, US firms on average have much better internal information systems compared to firms, for example, in Italy, which is my own country. As a consequence, we may expect that country-level investment may also change as a function of both inflation and average firm internal information system quality. And again, this is exactly what we find in the data. The coefficient beta 1 is significant and positive, and beta 3 is negative and significant. But once again, you may ask yourself, why do we care about this? What are real implications? And the reason this is important is because there is a crazy amount of variation in the productivity of different countries. As you can see from this graph, and this is somewhat of an extreme example, on average, US workers produce the same output that Tanzanian workers produce in 1 year over a 2 weeks period. So there are massive differences in productivity among countries, which means it's quite important to understand what drives those differences and what countries can do to reduce those differences. And our paper speaks of that by showing that incentivizing firms to adopt better internal information systems may be one way to reduce productivity differences across countries. Now, before opening up the floor to questions, I want to take a little bit of an aside. So far, I've showed you that internal information system quality matters a lot for managers' investment decisions, for their firm's productivity, and for country productivity as well. So you may be curious to know more about what drives variation in internal information system quality. Now, this is not the focus of this study, but this is something I work on a lot. And a result in the literature that's quite close to my heart is the one you can see in the slide. As you may possibly infer from the graph, there is a strongly positive correlation between the quality of firms' internal information system and the education of their employees. Now, what I'm about to say is a big extrapolation of what's in the graph. So it may even not reflect what the graph says, but I'm gonna say it anyways. So from this graph, I think we can take two big messages. Message number one, if you are a first-year student and you are in the audience and you have not taken my class, you should. Because in my class, you're going to learn about internal information systems, you're going to learn how to make better decisions, and therefore companies may be more inclined to hire you anticipating this effect. Now, message number two, if you are an employer in the audience, when you evaluate Fuqua candidates, maybe a good screening mechanism would be whether they took my elective, because in that case, they will know how to produce better internal information systems, which would allow your company to make better decisions. Now, on that shameless self-advertisement, we can close with the presentation. We can stop sharing the slides and open the floor to questions if there are any. Okay, so I see we have a couple of questions. So let's start with question number one, which is, couldn't firms take advantage of inflation by raising their prices at the expense of customers? Okay, this is an important question. It's not the focus of our paper, but I believe it gets at the broader issue of who has agency of raising prices in the economy. Is it that consumers drive prices, or is it that firms have price power? Now, again, this is not the focus of our study, but it's something that matters to us. And what we tried to do was to partition the sample as a function of firms' pricing power to see whether the results we document apply to both samples, only the subsample of firms without pricing power, or only the subsample of firms with pricing power. And what we find is that our results apply exclusively on situations when there is lots of product market competition, which means, broadly speaking, that those firms do not have pricing power. So when you take the results of our paper out of context, what you can conclude is that they are not going to extend to firms with significant pricing power, and they will apply exclusively to firms without pricing power, firms that face lots of competition in the product market or face for which the elasticity of demand is quite high. Now, the second question is, what would you say are the most important implications of your study? Well, we think there's a number of implications that may be worth keeping in mind. There are some academic implications that I'm going to skip over because those are less interesting to this audience. But what I think is more interesting is thinking about the implications, for example, for investors and lenders or for regulators. So let's start from the first category, which is investors and lenders. Well, one important message you can take out of the paper is that if you are an investor or if you are a lender, you can anticipate that firms with better internal information systems will be better able to tease out whether their financial performance is driven by idiosyncratic shocks or nominal shocks. And as such, those firms are likely to make better investment decisions. So that's something you may want to keep in mind in your investment or lending decisions. Now, skipping instead to implications for regulators, what we think our paper does is to show that for regulators, it's quite important to keep in mind the composition of the sample of firms that they're going to affect. Let's assume, for example, a regulator wants to tackle inflation by changing their monetary policy. Well, the effects that the monetary policy will have on firms vary massively as a function of those firms' internal information systems. So when evaluating different policies, it may be important for regulators to keep that firm-specific aspect into consideration. And that, by the way, is quite consistent with what Janet Yellen mentioned when she was chair of the Fed by suggesting that researchers should focus more attention on firm characteristics when evaluating the consequences of policy regulations. Now, I see that we don't have any residual questions. So I want to thank you for your attention. I'm excited I had the opportunity to share my research with you, and I want to invite you to join us any first Wednesday of the month to learn more about what our excellent faculty is up to. Thank you again for sharing. It was a pleasure to spend time with you.